Money can't buy you happiness. Okay, but your relationship with money can affect your health. Going for a stroll in the great outdoors is good for you, so I'm told, because we talk about our physical health all the time, along with our goals and our dreams. Thinking of how we're travelling the road ahead is a must. With that said, starting my journey on personal finances feels a lot like running does to me right now. I hate it. I think the same preconceived ideas I had for running are the same that I had for investing. I need to be rich in order to start is similar to I need to be healthy in order to run. Both not true. There are many different routes to go down, and generally the rule of thumb is spend less than you earn, invest early and often. When I started my first business, I had no clue about what was available to me at the time, and it felt overwhelming. There is a lot of information out there, and it's more than okay to seek help. You just have to keep sharp about whom you were asking. You're not going to run your first ever marathon after reading a review for a running shoe, nor are you going to put your life savings on a single stock because you heard about it gaining momentum. Identifying and researching has brought you here, so you're on the right path. With it all said and done, the best way to get good at both investing and running is to start. Well, here in the UK we have inflation at around 2 to 2.5% per year. That means that every year prices and stuff goes up by 2 to 2.5% every year. The old adage of keeping our money under our mattress may come from not trusting banks per se, and I can somehow understand that. However, by doing so and not investing, we are losing a lot of spending power on our money. With inflation hitting, that would also decrease the value. Inflation is one key factor the Bank of England considers when setting the base rate. That influences what rate banks can charge people to borrow money and what they pay on their savings. So instead of a mattress, we all keep our money in a savings account. According to the FDIC, the national average interest rate on savings account currently stands at 0.05%. So if inflation is at 2% each year, then by keeping our money in a savings account, again, we are losing value on our money and quite a lot of spending power. But we're not looking for our money to keep its value. We want our money and our savings and our profits to grow. So how do we make money with investments? Well, to understand this, we need to first ask, what is an investment? An investment is an asset or an item acquired for the goal of generating income and or appreciation. For example, an investor may purchase a monetary asset now with the idea that an asset will provide income in the future and later be sold at a higher price for a profit. Investments can also be a little closer to your home, or rather your home. If you buy a residential home that needs work and then you add value, that along with have a time factor, then your initial investment will go up. And if you go on to buying a second and third property to generate income too, that is an investment in work. However, we need to factor in lawyers' fees, transaction fees, mortgage brokers, builders, estate agents. In theory, property should outperform a dividend paying fund, but is it worth the hassle? So how to invest? Okay, so we can't go down to the shop and buy a pint of Amazon, understandably. In place of that, it's actually become a lot easier as there are a ton of online brokers. For example, I personally use Hargreaves, Lansdowne and Vanguard. Once you open an account with them, you'll most likely open a stocks and shares ISA and invest through them. Now let's quickly talk about how there's a ton of trading apps putting out ads that are giving us FOMO. They're more directed at CFDs, and where there's lots of money to be gained, there's also a lot of money to be lost very quickly. They're illegal in the US, but not as regulated over here, just like the bookies. You enter at your own risk. I'd say if you needed to scratch that itch, then I would look at your investment budget per month. I would take 90% and put them in an index fund, and then 10% and play around with picking stocks, and then see how you get on with that. What's an index fund in play? There's an index fund for anything that generates money. Broad market index, short-term bond, long-term bond, FTSE 100, S&P 500, real estate, small cap, large cap. Now, depending on your preferred sector, not all indexes will be created equal. You'll have to decide what one best suits you. Like my runnings video at the start, there's an abundance of running shoes. Some might look and do the exact same, but the administrative costs may vary wildly. The minimum required to invest can be as high as a few £1,000s for some funds, so you might want to look at that. A broker's account minimum might be 0%, but that doesn't always remove investment minimum for a particular fund. This is one of the main costs subtracted from each fund shareholder's return as a percentage of the overall investment. For context, the average annual expense ratio was 0.09% for stock index funds and 0.07% for bond index funds versus 0.82% for actively managed stock funds and 0.58% for actively managed bond funds. In essence, it's a management fee and we want to keep those pretty low. Say for example, if you had 1 million, 1% of 1 million is 10,000. It's a lot to think about. Like the expense ratio, these taxes can take a bite out of investment returns. Typically 0.3% of returns in an index fund. Fund Tracker Morningstar calculates tax cost ratio, which shows the percentage by which funds' performance has been reduced by taxes. As we discussed in the last video about index funds, with home bias, Brexit uncertainty, the most popular class of index funds right now linked to the S&P 500. Vanguard 500, also known as the Vanguard S&P 500 Index Fund. This fund was founded in 1976 and is considered to be the granddaddy of all index funds. Like the other S&P 500 funds on the list, this fund gives exposure to the 500 largest US companies, which make up about 75% of the US stock market's total value. Minimum investment $3,000, expense ratio 0.04%. Schwab S&P 500 Index Fund. As research from Morningstar notes, this is one of the cheapest and most accessible S&P 500 tracking funds out there. Launched in 1997, the Schwab fund charges a scant 0.02% expense ratio and requires no minimum investment, making it an attractive for investors concerned about costs. Fidelity 500 Index Fund. Founded in 1998, formerly known as Institutional Premium Class Fund, Fidelity removed this fund's investment minimum last year, so investors with any budget size can get into low-cost index fund action. Minimum investment, zero minimum, expense ratio, 0.015%. Fidelity Zero Large Cap Index Fund. In the race for the lowest of the low-cost index funds, this Fidelity fund made news last summer by being amongst the first to charge no annual expenses, meaning investors can keep all the cash invested for the long run. Minimum investment, no minimum, expense ratio 0.0%. T. Rowe Price Equity Index Fund. Founded in 1990, the fund's expense ratio is competitive with other providers, but the 2,500 minimum may be steep for beginning investors. Minimum investment 2,500, expense ratio 0.2%. Might there be an investment out there that will beat the ones in your portfolio? Yes, but you could lose a lot of time and money in searching for that. Don't give in to FOMO, as owning the stock market over the long term is a winner's game, attempting to beat the market with small wins and losses peppered throughout your investments is a loser's game. Thanks for watching. Good luck with your investments. Remember, low costs, long-term growth. Thank you.